Next question. Mrs. Roly Limited wants to acquire Mrs. Polly Limited. So Roly is acquiring company and Polly is target company. The following is the balance sheet of Polly Limited, that is target company, as on 31st of March. Equity share capital, in that 1 lakh number of shares face value is 10. The retained earning 3 lakhs. 12% debentures again 3 lakhs. Creditors and other liabilities 3 lakh 20,000. On the asset side, there is a cash balance of 20,000. Debtors 50,000. Stock is 2 lakhs. Plant and machinery 16 lakh 50,000. Shareholders of target company Poly Limited will get 1 share of Roly Limited, that is acquiring company, at current market price of 20 for every 2 shares. It means that the exchange ratio is 0.50. External liabilities are expected to be settled at a discount of rupees 20,000. Debtors and inventory are expected to realize an amount of rupees 2 lakhs. Poly Limited will run, highlight the portion, as an independent unit. CFAT, cash flow after taxes, is expected to be 4 lakh rupees per annum for the next 6 years. Assume the disposal value of the plant after 6 years will be 1 lakh 50,000. Poly Limited requires a return of 14%. 1 to 6 factors have been given at the rate of 14%. Advise the board of directors on the financial feasibility of the proposal. So basically from this information we are required to compute from Roly Limited point of view that whether it should acquire Poly Limited or not. I request all of you to go through the question and then we'll discuss how to do it. So friends, over here we have to take decision from Roly Limited point of view whether to acquire Poly Limited or not. On acquisition there will be certain advantages, or we can say that there is a kind of present value of the cash inflow, and there are certain costs, that is present value of the cash outflow. Okay, as per the given information we can say there is 4 lakh rupees of the cash inflow for next 6 years, and 1 lakh 50,000 rupees is the cash inflow at the end of the 6th year. So we will be having, listen carefully, annual cash flow into PVIF at the rate of 14% for 6th year. Terminal cash flow into PVIF at the rate of 14% for 6th year. These are the present value of the cash inflow. Further understand that debtors and the stock will realize together an amount of rupees 2 lakhs. That is further cash inflow like this. Cash balance, of course, for that so there is no change in the value. So the cash balance as it is rupees 20,000. So these are the cash inflows so on acquisition. And what are the cash outflows, friends? We understand that say the exchange ratio is 0.50. Number of equity shares of the target company is 1 lakh. 1 lakh into 0.5, that is 50,000. The price per share of the acquiring company before merger is 20. So 20 into 50,000, that comes to an amount of 10 lakhs. That is the present value of the cash outflow. Next, external liabilities are supposed to be settled at a discount of 20,000. We understand that so this is 3,20,000 minus 20,000. That comes to an amount of 3 lakhs. Okay. This is the way we will have so the cash outflow. For the debentures, it will be as it is. That is an amount of 3 lakhs because no other information is given for the same. Okay. So now we were required to make a comparison that what is the present value of the cash inflow And what is the present value of the cash outflow? If at all the present value of the cash inflow is exceeding the present value of the cash outflow, then in that case, Roly Limited is advised to take over the Poly Limited, not otherwise. So let us answer the question. First point, in this question, from Roly Limited point of view, comma, we have to decide whether to acquire Poly Limited or not. Second point, for the purpose of decision making, we have to compare present value of cash inflow with present value of cash outflow. Full stop. Third, if NPV, net present value, is positive, comma, acquire Poly Limited, not otherwise. This is the way we are required to take the decision. Working note number one, calculation of present value of cash inflow and present value of cash outflow. So please write an answer. Present value of cash inflow amount, present value of cash outflow amount. Shareholders of Poly Limited, that is this portion, will get one share of Roly Limited at current market price of 20 for every 2 shares. So we understand that there are 1 lakh equity shares into 0.5. So it comes in the present value of the cash outflow, shares consideration. In that we understand it is 10 lakhs divided by 10, that will give the number of shares. It is 1 lakh into 1 by 2. So the exchange ratio is 0.5, that is 50,000 shares into 20 rupees per share. So 10 lakhs upon 10 divided by 2 into 20. That comes to an amount of 10 lakhs. Next is provided to us external liabilities are expected to be settled at a discount of 20,000. So we understand that's the payment for the external liabilities. In that case, it is 3,20,000 minus 20,000. That comes to 3 lakhs. Next is the debentures. It is also an amount of 3 lakhs. That is this portion. Poly Limited will run as an independent unit. CFAT is 4 lakhs per annum for next 6 years. So we can say something like this. Present value of the cash inflow. It is annual cash flow into PVIFA at K cost of capital for n number of years. So in that case, it comes to an amount of 4 lakhs into PVIFA at the rate of 14% for 6 years. So we are required to make the calculation of the factor summation. 0.877, 769, 675, 592, 519, 456. That comes to 3.888. 4 lakhs into 3.888. 15,55,200. Okay. The last year there is terminal cash inflow. So in that case it will be 1,50,000 into PVIF, because it is going to be received at the end of the 6th year at the rate of 14% for 6th year. So 1,50,000 into 6th year factor is 0.4560. So 1,50,000 into 0.456. 68,400. So present value of terminal cash flow. Okay. Afterwards, we have been provided with the information that debtors and the inventory will realize an amount of 2 lakhs. So this to total 2 lakhs and cash balance as it is. For plant and machinery, we are going to use it for 6 years. We are going to do business by using the plant and machinery. And then at the end of the 6th year, we are going to sell it for 1,50,000. So the current value which is given to us is of no use to us, because we cannot sell the plant and machinery right now. If at all we sell plant and machinery right now, then how can we do business? So we understand that so the cash balance will be as it is, rupees 20,000. This is the way we will have cash inflow. 15,55,200 plus 68,400 plus 20,000. So in that case it is 16,43,600. Cash outflow will be 10 plus 3 plus 3. That comes to 16 lakhs. So difference of both of them is considered to be the NPV. Friends, over here we are required to take into account the debtors and inventory. An amount of rupees 2 lakhs. Sorry, I forgot to consider it. Accordingly, we will have the PVCI and PVCO. So present value of the cash inflow 15,55,200 plus 68,400 plus 20,000 plus 2 lakhs. So 18,43,600. And present value of the cash outflow is 10 lakhs plus 3 lakhs plus 3 lakhs. So the total comes to 16 lakhs. So difference of both of them is what we understand is the NPV. So let us answer. Net present value is present value of the cash inflow minus present value of the cash outflow. 18,43,600 minus 16 lakhs. 243,600. That is the way the NPV is found. So this is the way we compute PVCI, PVCO, and based on that, so the NPV is calculated. Please write down a small note for the answer. First of all, decision. Roly Limited should acquire Poly Limited. Further argument that we understand that by using plant and machinery, the company is doing business, comma, so its scrap value is relevant for answer. Full stop. Current book value is of no use. Full stop.